Hi, everyone, and welcome to AIADA's Auto Talk. I'm your host, Rachel Solomani. We've made it to the end of the year, and we have a great program for you today. I really can't think of anyone better to close this out than Cox Senior Economist Charlie Chesbrough. Charlie, I'm keeping my intro short today and letting you have the floor to get into the end of this year and some of your predictions for next year.
Okay, well, thank you very much for having me here today. And yeah, I haven't talked to everybody here since I think it was September was the last time maybe we met. Lots been going on since then. We're going to give you an update as to what we're seeing out there for the vehicle market at year's end. But I'm titled my presentation, What's Next After Trump Administration Policy Changes? Because really, that's been the big story so far in 2025. President Trump's policies of the tariffs and the EPA mandates changing, as well as the big, beautiful bill, and all of that have had dramatic impact on vehicle sales. And we're going to walk you guys through some of the numbers that we're seeing. So we're going to cover the economic and automotive outlook, and really the concerns are rising out there. There's a lot of mixed signals that we're getting. And then we're going to talk a bit about the market itself, and that we're starting to see the pressure is going to be rising on vehicle prices. And I think that's one of the stories for 2026 is how aggressive do the manufacturers get in raising prices to try and recoup some of the losses that they're going to be facing as a result of these tariffs. And then I'm going to talk a little bit about the big, beautiful bill and how this actually could be a bit of a plus here for the vehicle market. So leave you guys with a little bit of optimism here as we go into the start of the year. But just to look back a little bit, the year in review, a couple of big points to make to everybody this year. A couple of things that kind of jump out at us here at Cox Automotive, and that is we have a bit of a wind chill economy. And that is that the consumers out there are stating that they don't like what's going on. They're not feeling comfortable. Economic indicators from the consumer's perspective look pretty bad, but still positive. But we're starting to see that the sentiment around inflation has really left people in a very negative situation. And as a result of that, we're getting sort of into the number two, which is a bifurcation in the U.S. economy. People have been talking about this K economy, where high-income people are actually doing quite well, but lower-income folks are really seeing the strain. Now, for the new vehicle market, of course, the high-income folks is really what's driving activity. But on the used vehicle side, those low-income folks are really what drives that market, and they're certainly under a lot of strain right now. And then the third point is the tariff pain. We've seen a lot of volatility that's been unleashed as a result of these tariffs, and I think it's something that we're going to see more of that pain here this next year. The manufacturers had a very difficult time trying to respond to these tariffs, in part because the president kept changing the policy and changing the plan and pulling back as negotiations were going on. And it made it very difficult for the industry to really respond. But I think in 2026, we're going to see more of a formulated strategy as to how they're going to address this. And it seems to me that we're likely to see higher prices out there, either in terms of the MSRP itself, or in incentives actually coming back down in order to recoup some of those losses. And this roller coaster is likely to continue. The industry experienced a lot of ups and downs as the policy changes changed, and we're likely to see more of that in 2026, although hopefully less so, because a lot of stuff's already been changed. So I don't know how many more things how many more levers can be pulled, but we'll see. But let's start by talking about consumer sentiment. And I've shown this slide before, but I still think it's very interesting. It's from the University of Michigan, and they survey thousands of consumers each month and ask them, what is your outlook on the U.S. economy? And we've got about 60 years worth of data here, or 50 years worth of data. And you can see on the far right as to where we are right now. We are very close to all-time lows. And those all-time lows happened in June of 2022. And consumers are saying they're still feeling as bad now as they were during the depths of the inflationary period right after the COVID crisis. And it's actually fallen quite a bit in the last year. The consumer confidence, which was on a little bit of a rebound in the post-election period, has fallen dramatically, and it's down 38% year over year. And you can see historically we've had, when we're at this level, it's been when terrible things are going on, like we had the double dip recession of the early 80s and the S&L crisis of the late 80s, early 90s. The 9/11 terrorist attacks weren't even this bad. The Great Recession of 2007, 8, and 9. We're at a level that consumers think is even worse than that regarding the U.S. economy. So the outlook out there looks fairly pessimistic, and I can't think of a time in U.S. economic history that we've had consumers this far in the doldrums and not seeing it impact consumer spending and thus leading us towards a recessionary environment. But what's interesting is it's kind of, we're still divided as a country. And the University of Michigan also asks, what is your outlook on the economy, and splits it out by political affiliation. And what's interesting here is you can see that the blue state folks think this is as horrible a time as that we've had, at least certainly going back the 10 years that are on this data set. But they're at an area where red state folks were back in June of 2022. The blue state folks think the period right now is terrible. And as we can see, the independents in purple are actually leaning more towards what the blue state folks are seeing. And yet red state folks are still remain fairly elevated, although nowhere near the levels of optimism that they were at prior to COVID. So the real reason to point this out is not to stir the pot, but really just to point out that we need confident consumers out there, because they're the ones who are going to go out and buy a vehicle. You got to have a certain amount of confidence to take out a $40,000 or a $50,000 car loan and buy a new vehicle. And so you would think that those folks that see the glass as being a little bit half full right now are going to be less inclined to be taking out those big loans. So this could impact who's coming in to be buying a car these days. We also do a survey at Cox Automotive where we ask each quarter our dealers what is their outlook right now on the marketplace. And our dealer sentiment index came out a couple of weeks ago, and you can see on the far right we got a number of 38 for overall for the entire marketplace out there, with franchise dealers a little bit higher than where independent dealers are. But everybody saw quite a big shift down. And in fact, we haven't been doing this survey for very long, but going back to 2019, you can see where we are today basically puts us where dealers thought the market was really in the depths of COVID. So we got to go back 5-6 years to be looking at that. And it really kind of suggests that dealers are getting a little bit more pessimistic themselves on what the outlook looks like for the marketplace this next year. And in fact, we measured that in our data, and we were asked them, what are the factors that are holding back your activity right now at your dealership? And you can see, and highlighted in red here, where we've seen the factors that have made significant moves since the third quarter. So really just over from the previous quarter. And you can see the economy has quickly moved significantly higher just over the last 3 months, really reflecting this uncertainty that we have out there and real concern that things are starting to slow down, and that a lot of the concerns that we saw in the consumer confidence number are shared by car dealers. Market conditions are starting to get more unfavorable. We can see that that's rising. And the political climate itself, which had actually been getting a little bit better in the wake of the elections last year, but are now starting to rise again. Real concern about what the political uncertainty could mean for the overall economy. So it's a really kind of, when you're asking people what they think out there, you can see the general mood is one of not too much optimism. And part of the reason is that we're just seeing metrics that aren't looking too favorable. This number is looking at the consumer price index, and this is going back to 1960, the year over year change in prices, and that's really the inflation measure. And you can see where we are today. We just had a number that came out this morning, 2.7% in November, and that's down from the 3% that we had in September. We never did get an October number because of the government shutdown, but a lot of analysts on Wall Street were expecting this number to be significantly higher. More towards 3.1% was the inflation number that many were expecting. So this actually surprised to the good side, and we've seen the stock market has gone up quite a bit. But this means that the concern that folks had about inflation really starting to accelerate, at least for now, don't appear to be showing up in the data. And now there is some concern that maybe we're not getting complete data right now, or the numbers are a little bit funny because of the government shutdown and all that. It's hard to say. We certainly will know more here in coming months. But at least we can say with some certainty that the idea that inflation is taking off just isn't the case, because we're just not seeing that in the numbers just yet. But we did get numbers earlier that were suggesting that the employment situation is starting to change out there. We just got a number for November. 4.6% was the unemployment rate. That was up 0.2% from where we had in September. And it is really the highest rate that we've had since the about 5 years, going back to the COVID period. So the inflation rate is definitely starting to rise out there. And we have to keep in mind that this number may be a little bit skewed to the more less growth seen in this number, because a lot of folks have been removed from the country through the new immigration policies. We've had some of the labor markets actually kind of disappeared, so there's not as many people to be unemployed. And so that may be softening this number a little bit, but clearly it is moving in a direction that is unfavorable for the economy, and certainly unfavorable for the vehicle market. And part of the reason is that we can see that job creation has really started to weaken significantly. This is a chart that's showing the monthly gain in employment, the change in the monthly numbers. And generally, the U.S. economy has to create anywhere from 125 to 150,000 jobs a month to essentially stay stable. That we have a growing economy, a growing workforce, a growing population. So just to maintain sort of stability, we need to create a certain number of jobs. But the most recent numbers have been suggesting we haven't been creating that level. In November, we only created 64,000 jobs. And in October, they actually showed a loss of 105,000 jobs in October. So you can see I've circled in red this whole area here is suggesting that job creation is starting to weaken in the U.S. economy. That is lifting the unemployment rate. And again, it does suggest that there's sort of recessionary winds starting to blow out there. And probably one of the more concerning indicators of that is consumer spending. We need folks like you and I to go out there and be spending money. That accounts for about 70% of all economic activity. If consumers start to pull back their spending, then we almost certainly see the economy run into a recession. And this is a metric from Bloomberg, which is tracking year-over-year changes in weekly spending. And you can see the blue line there is the 4-week moving average. It's been relatively weak over the last year. It's not growing at a fantastic rate, but you can see over the last few months it's been trending much lower, and essentially now we're at the point where it might drift into negative territory, which means consumers are spending less this year than they did a year ago, and that is not a good sign for the U.S. economy. So again, just another indicator to suggest that things are looking a little bit tough out there. And so we've been suggesting to folks that we want to take a conservative view on 2026, that I think it's going to be very challenging to see vehicle sales growth over what we had this past year. Certainly not impossible, but there's just a lot of headwinds out there right now that we're seeing from consumers. But the vehicle market is a much different market today, and that's something we have to keep in mind. We talk about the K economy, where the higher incomes are doing particularly well and the lower incomes are not. Well, in the vehicle market, part of the reason that the vehicle market has been doing fairly well the last couple of years is because we have a much more affluent buyer in the new vehicle market today than we had before. And this is a chart that is showing the percentage of the marketplace that is coming from different income groups. And really the big story here is you can see that the incomes above 200,000, their share of the new vehicle sales market has been rising significantly over the last few years. In 2020, the share of buyers that made over $150,000 a year was about 18% of the market in 2020. Now those buyers are about 29% of the new vehicle market. And where have they been taking share from? Well, those folks that make less than $100,000 were 50% of the market in 2020. Now they're down to just 37% of the market. So part of the issue out there is new vehicles are getting more expensive they're kind of pricing themselves out of the affordability range for many consumers out there, and only higher income folks remain that can buy these vehicles. And so that's driving up these average vehicle prices, and is reflecting this idea that we have a K economy in the new vehicle market. And that's something that we're going to have to be dealing with here throughout 2026. So let's talk about the market itself. And this is where I think it's quite useful to kind of understand what was President Trump's policies this year and how did they impact vehicle sales. And I think the best way to kind of review this is looking at the monthly light vehicle sales SAR, or the monthly selling rate. And what I'm showing here is each month in light blue is what we sold in 2024 in last year. And then in 2025, in dark blue is what the selling rate has been this year. And you can see for the most part in January and February, the market pretty much was unchanged a little bit, with this year up a little bit over last year. But then we see in March and also in April, the sales pace just exploded. And that's when the president announced at the end of March these new tariffs. And a lot of buyers out there that were thinking of purchasing a vehicle decided to run out and buy, because there was all this talk that the tariffs that the president was going to put on was going to jack vehicle prices by a huge amount and very, very quickly. And frankly, it probably would have had he stuck with the original plan that he was initially talking about. But he had since made some adjustments and many alterations to his tariff policy. But we can see that consumers reacted very positively, at least in terms of sales, and wanted to go out and buy. Once we got through that surge, we saw that May and June basically fell back to normal territory. And then we see in July, August, and September, the pace accelerated yet again. And this was because on July 4th, the president signed the big, beautiful bill. And in that bill, they eliminated the EV and plug-in hybrid tax credit, and that was going to go away at the end of September. So we saw a surge of activity from buyers going out and wanting to take advantage of that $7,500 deduct or tax credit they were going to get before it expired. And so we saw a surge of activity. Then at the end of September, when that expired, you can see that for the fourth quarter, October, November, December, the sales pace has dropped back down far below the levels that we had done last year. So the pace has definitely shifted from having a good year all through the first three quarters to now slowing down tremendously. So all of this means that we expect this year to finish on the whole at about 16.2 million, up about 2% from where we finished last year. But our forecast for 2026 is we figure the market is going to be down about 1 to 2%. And really, it's for many of the reasons I just described through the U.S. economy being a little bit slower, and the tariff prices themselves making vehicles a little bit more expensive. For the used vehicle market, it's a similar story as well. We expect the year is going to finish up a nice, healthy about 3%. But we think that it's going to fall a little bit next year because there's going to be less trade-in activity, likely higher prices, and of course, just the challenging environment that we have out there for many potential vehicle buyers. When we look at what's sold in the market this year, it's really kind of interesting because it does kind of reflect the nuances of this K economy and how it does impact the vehicle market. This is a chart that's showing the 10 largest vehicle segments, which accounts for about 87% of total sales activity. And we can see that the big decliners this year: mid-size car, luxury compact SUV, compact car, down on this year. And in fact, mid-size car and compact car are two of the most affordable product segments that we have in the new vehicle market, and yet they're down quite a bit. At the other end, though, we can see that what has risen quite a bit this year, well, it's mid-size truck, but it's also full-size SUV, it's full-size trucks. These are products with $65,000 plus price tags, and yet they're looking at very sizable gains this year. So although there's a lot of talk about affordability out there and that people can't afford these vehicles and it's challenging for everybody, all that is absolutely true, but it's not true for everybody. And there certainly are buyers out there that can absolutely afford these prices, and they've been buying quite healthily in certain product segments. Like, again, that's something to keep in mind here when we evaluate the market. And one important thing I don't have a slide on this in terms of talking about the manufacturer numbers themselves, but one thing that we did see in 2025 is that The top four manufacturers, GM, Toyota, uh, Ford, as well as Hyundai, all saw their market share rise, and combined, the top four saw their market share rise 2.6%. That's a big change in market share over the course of the year. And nearly every other manufacturer out there lost market share. And to me, the takeaway from that is that the biggest are getting bigger. And the reason is that they've got a big product portfolio with products across many product segments and in many powertrain configurations, that they're able to provide a product for whatever the interests of the potential buyers are, as opposed to other brands which are much more specialized and may not be able to have a full plethora of choices available for the consumer. So that may become an even bigger issue here as we move forward. And looking at the supply situation, it's actually been rising here over the last, as the market's been slowing here in the fourth quarter, we've seen the supply situation change quite a bit. This chart is showing what, from our Auto data, is what is on dealer lots and in transit across the country. That's in light gray. And currently we have about 3 million vehicles out there on dealer lots. That's about 6% less than we had this same week a year ago. But it's still a relatively healthy amount and is sort of back to where we were during pre-COVID period. But the key metric here is days of supply, or how long will this inventory last based on our current sales pace. And as I said, it's risen dramatically. It's up about 23% over the last 90 days because the overall market has been slowing. And that's what that dark blue line is there. We're nowhere near the very tight inventory market that we had back in 2021 and 2022. But the days of supply number is down a little bit from a year ago. But what's really interesting is the composition of what makes up this inventory right now. And currently, about 60% of it is model year 2026. And the important note of that is that we're going to get, it's only going to get more and more the composition of the supply base of the newest products. And that means we know that most of the vehicles sold in 2025 were on vehicles that didn't have to pay any tariffs. Those vehicles were built before the tariffs were implemented, or the president had made so many policy changes that the tariffs weren't that heavy for many products for quite some time. But that's not going to be the case in 2026. Almost every vehicle that's a model year 2026 will be manufactured underneath these new tariffs. And we know that just steel and aluminum alone is adding anywhere from $800 to $1,000 to the cost on these vehicles. So the cost pressures are going to be rising over the course of this year as the inventory becomes more and more of the latest model year. And just looking at the different brands, we know that although we're at 90 days of supply nationally, the brands are all in a very different situation. As we can see, Toyota and Honda on the far left, they're looking at days of supply well below the national average. Their supply situation, as everybody's has seen days of supply rise a little bit over the last 90 days, but they still remain in a relatively tight inventory situation. And we would expect that their discounting would be quite minimal at this point. At the other end of the spectrum, you can see Ram and Jeep, both with days of supply of 4 months or more. And so that's a situation where Stellantis is likely to be having to be aggressive on many of their incentives in order to move that metal, or else they're going to be looking at inventory accumulating even further than what it is right now. And one of the strategies, as I just mentioned, is the incentives. And what we can see here, this is a chart that's showing incentives as a percent of the transaction price. And on the far right, you can see where we are today. We stand at about 6.7%. This is down a little bit from where we were just a couple of months ago. And frankly, we were kind of expecting this, that the manufacturers would pull back on incentives somewhat in order to recoup some of the losses that they're going to be facing from these higher tariff costs. And so, how aggressive do they get? I think it's unlikely that we're going to get back to the seller's market of 2021 and 2022, where essentially there was very little negotiation to be had, and incentives were as close to nothing as we're going to get. But it's possible we could see them go down even further. It's really going to depend on if demand can hold up at a relatively healthy pace, or if we do see the consumer demand is choked off from these high prices and weakening economy, the manufacturers are going to have to use this lever in order to help spur the market here if things get really tough out there over the first half of the year. And one of the things we're going to be looking for is the new vehicle prices, and we're expecting them to start rising again, maybe at a little bit faster clip than they had been. On the left here, that is showing the average monthly transaction price. And what's interesting here is I've highlighted here the dotted blue line. That was the trajectory that prices were on prior to COVID. And we can see that inflation was somewhere in the neighborhood of about 3% per year is what we saw throughout the 2010s of what vehicle prices rose each year. But then when COVID hit, you can see that prices really started to accelerate dramatically as the lean inventory environment changed the product mix that manufacturers were focused on, as well as consumers themselves and a more affluent buyer in the market wanting to buy a more expensive vehicle. All of this sort of drove up the average price. But you can see that dotted blue line shows where the market would have been had we not had sort of this COVID interruption. And that prices today still stand about a good 10% above what sort of normal trend would have been. So there is this feeling that vehicle prices are expensive out there. And this is one reason why folks feel that way. But the real interesting measure is the year over year change in those prices, and that's what's on the right. And as I mentioned, historically, we had about a 3% inflation rate in vehicle prices throughout 2010s to just prior to COVID. But then prices really exploded during this COVID period. But then they fell. In fact, prices were actually falling for much of 2024. And then into 2025, though, they started to turn positive again. And you can see that the trend has definitely been rising. It's been volatile, but our expectation is that we're going to see these vehicle prices start to rise a little bit more aggressively here through the course of the year. Now, the one caveat to this is when we're looking at the national average, we may see that it doesn't rise as much. Because folks are going to buy more affordable vehicles, therefore the average transaction price is lower versus comparing an apples to apples Toyota Corolla now to a Toyota Corolla then, or an individual nameplate now to an individual nameplate then. There we may see more aggressive pricing. So as a team, we've been trying to figure out how best to illustrate the price threat that we see out there, and that may be something we're going to look for as to whether it's going to be at a nameplate level or whether we can still stick with the national aggregate. But we do know that the manufacturers are trying to hide as much of the price increase as they can. We have not seen massive moves on MSRPs just yet, but we have seen anecdotally some dealers talking about that delivery or destination fees have been going up, as well as on that incentive chart I showed you, the manufacturers themselves pulling back a little bit on incentives. All of these things are going to help spur higher prices here through the course of the year. And we're also seeing this in the used vehicle market. This is showing the used retail price, and right now it stands at about $25,730. And just like we had big inflation in the new vehicle market, we had really high inflation in the used vehicle market during those early COVID recovery days. But from 2023 and 2024, we saw prices were in negative territory for the used vehicle market as they were giving back much of that ground that they had gained during the lean inventory times. And then earlier this year, as I've highlighted in red, we saw these used prices actually turn positive again. And that's our expectation, is that we're likely to see these used prices rise even further here through the course of the year as and more folks are going to be interested in buying these vehicles because they've been chased out of the new vehicle market. But again, it's going to be contingent on whether the economy holds up or if we really start to see significant job losses. If the economy still holds up and we're just looking at mild increases in unemployment rate and and job creation not very strong, we can probably weather through that. But if we do see a significant recession and we do start to hear about very high job losses, I would expect the used vehicle market to start to suffer, and we may see prices actually come down as a result of that. One of the interesting things, though, that we are seeing in the used vehicle market is where the price increases are really coming from. And this is an analysis we did looking at the average price of 3-year-old or younger vehicles and how that's been changing versus all other vehicles, the older model years. And what you can see here is that looking at the dotted line, that's sort of the whole industry. Overall prices are actually down a little bit or essentially flat on a year-over-year basis. But when you look at the 3-year-old vehicles, sort of the gently used, off-lease, CPO type products, they actually saw a big price jump this year, up 2.8%, again reflecting this idea that maybe there are some folks in the new vehicle market that have been chased out and are now interested more in the used vehicle market because that's more their price point. And we're seeing some evidence of that here with some of these numbers. So let's talk about the One Big Beautiful Bill Act that was passed on July 4th. The president touted this as being a big plus for the economy, and there could be some truth to that for the new vehicle market. There is potentially a lot of upside potential as a result of this bill. One is that they put in the auto loan interest deduction. Now, this allows folks that make less than $150,000 a year as an individual or $300,000 a year as a married couple. They can deduct some of that interest. And it phases out once you get over $100,000 income. But the idea is that you can deduct some of the interest that you're paying on that loan. And it's not a huge savings. I don't think it's going to move the needle a lot. And I did a basic math for you here, but essentially it could save about $400 a month on a excuse me, $400 a year on your payment from that deduction. So it's actually scheduled right now to phase out in 2028. So really only a total potential savings for someone who bought a vehicle, and it's they retroacted it to January 1, is about $1,600. So that's not a huge amount of money for someone in the new vehicle market, but it's certainly not going to hurt. The other thing they included in the Big Beautiful Bill was 100% bonus depreciation for big SUVs and trucks. Now, these are more fleet type vehicles or very large mid-sized type products. But what it means is that a business can buy one of these vehicles and deduct the entire amount in 1 year. Normally, it sort of was over a 5-year schedule that you might have to deduct a little bit of this purchase over time. But this law allows businesses to deduct the entire amount. So essentially, they could claim zero profit and pay no tax because they have a huge deduction here from these fleet vehicles that they might be purchasing. This could be a big plus for the vehicle market, certainly certain segments of the new vehicle market. And it also works for used vehicles as well, as long as it's new to the buyer. Used vehicles could also qualify for this bonus depreciation. The other big change that was in the bill was elimination of many of the CAFE requirements and other things that have been done in terms of the California waiver revoked, essentially weakening much of the fuel economy standards and the moves that were made by the Biden administration. This is going to be a big plus for the automotive industry. We've already seen the stocks of Ford and GM have been responding quite positively in the wake of this. This is going to allow the manufacturers to really focus on many of the products that are much more profitable for them and of greater interest for consumers. But certainly it does have its downside. It's going to make the country itself that much more vulnerable to any kind of fluctuations in oil prices if we don't have strong fuel economy vehicles here. And of course, it does make us vulnerable to China, and they're going to be moving forward on electric vehicles. Will our own portfolios of electric vehicles be able to compete with maybe being developed offshore? I think that's where the real vulnerability lies. But on the whole, I think it is a plus for the automotive industry. The one negative of all this, at least in terms of immediate negative impact, is the elimination of that $7,500 battery electric and plug-in hybrid subsidy. And of course, less support for charging networks around the country. That's going to certainly limit interest on battery electrics. But that loss of those subsidies is going to impact sales, and it's impacting sales almost immediately. Now, one of the big pluses of this, though, and we did some analysis on this, is that we think that this big beautiful bill could result in a little bit of a spring surprise, in that because of all these tax law changes, we think that folks are going to be getting a bigger refund than they might be expecting. And again, we've got, I was on the previous slide, I was just talking about automotive specific related things in the bill. General economic things that are in the bill is there's no tax on overtime anymore, no tax on tips. The SALT cap was raised, the minimum deduction for many folks, a senior bonus deduction for people who are retired of $6,000, enhanced child tax credit, an increase in the standard deduction. And as I mentioned, the car loan deduction, all of these things are going to help folks have a lower tax liability. And the reason why there's going to be a bit of a surprise is that these tax laws are all retroactive back to the beginning of 2025, yet we didn't change the withholdings that people had in 2025. So in a sense, a whole bunch of people over withheld. They held out more money in their pay stubs than they needed to under this new bill. So we think that come the springtime, when tax returns start going out at the end of January and into February, people are going to get a much bigger refund than they were initially expecting. Somewhere in the neighborhood, on average, of about $750. Normally, it's about a $3,000 tax return the average American gets. It's going to be about 20% more than that. And we're expecting that about 10 million people that were normally paying a tax are now going to be getting a refund. It's flipping over about just 10 million people on top of that who are going to be getting money instead of having to give money. So we think this is going to lead to a very robust spring. And we could see a significant amount of activity in the used vehicle market, and maybe a little bit more in the new vehicle market, although probably not as much. But I think this was one of the silver linings that we're looking to out there. The question that we don't know is, what is the finances of consumers? Have they already spent this money? Is this money that they're going to see this extra cash and be like, oh, now I can pay the rent, now I can pay my credit card bill? Or is there enough money left over that now I can go out and buy that car that I really wanted to buy? We do know that when we got the $1,400 checks a few years ago during the COVID days, folks ran out and used that money to buy a vehicle. Well, they're going to be getting a little bit, half of that, but that may be enough that folks want to go out there and make that purchase again. So just something to be aware of here as we enter into January and February. But as I said, the elimination of those tax credits has had a significant impact on the market, and we can see it already in the retail leasing numbers. The big way that the elimination of the tax credit is going to hurt is it's going to make leasing that much more difficult for the marketplace. And this is a chart that's showing leasing as a share of overall retail sales. And you can see that when the Inflation Reduction Act was passed in the fall of 2022 and the $7,500 tax credit was established, the industry quickly started using that money as a capital cost reduction so that they could offer low-cost leases out there to electric vehicles. And you can see in the purple and the green there, the plug-in hybrids and battery electrics, their leasing rates just took off. And in fact, we look at what we were doing over the last 3 months there, you can see plug-in hybrids were leasing at almost a 70% leasing rate and battery electrics at a 60% rate. But we just got our October number. There's a little bit of a delay on this, and that's come down significantly. And I'm sure when we get into November and December, we're going to see these rates come down more. When we look at volume, the volume for these battery electrics and plug-in hybrids in October was down about 50% from where it was in September. So the volume numbers are going to come down. And this is why we think that we're just going to look at a little bit tougher year next year, because we have a huge portion of the market that is looking at a significant price increase. And so it's going to have a negative impact on some sales. It's also had an impact almost immediately on days of supply for battery electric vehicles. This is showing battery electrics in green, days of supply, and in blue is ICE vehicles. And you can see that once those tax credits expired, those battery electrics are starting to pile up, and they've had just a complete reversal of near 50 days supply in September to now approaching 150 by November. So the situation out there, and again, this doesn't include any Teslas or Rivians because we don't have that data, but you can clearly see that the impact of these policies is going to have a dramatic impact on the vehicle market, and we're really just starting to feel the effects of it now. And we're going to see the effects of this across the country, and it's going to be quite varied. Nationally, we were looking at about a 9% share of battery electrics, but that it quite varies across different states. With the West Coast, heavily invested in battery electrics, with California at near 23% share, Colorado at near 21% share. Large volumes are being sold for these things. But in other parts of the country, it's still just a trickle. They're still well below 4% of the market in anywhere that it's light gray. And so the impact of this policy change is going to be quite varied across the country, but it's just something to be aware of, that the vulnerabilities are really not going to be universally felt. And they're not going to be universally felt by the different manufacturers and brands themselves. This is a chart that is showing for each brand what percentage of its sales are coming from each of the different powertrain types. And 11% of the overall market is these plug-in hybrids and battery electrics. That's that purple and green out there. So you can see on the far right that Tesla and Rivian, which are 100% battery electric companies, well, their products are looking at a significant price increase. As is, Volvo, Cadillac, Audi, BMW. Many of these brands have really moved heavily into these alternatives, and so a huge portion of their portfolio is going to be looking at huge price increases, versus other brands out there that are focused on traditional hybrids, and that's what's in orange. And you can see that Toyota and Honda, their exposure to these new price increases as a result of the the tax credits going away is minimal. So they're not going to be as impacted as some of the other brands out there. So it's really, I think, a very important point to make, that the impact of these policy changes is not universally felt. But one thing we do know about what's going to be happening in the future is that we're going to have a whole bunch of battery electrics in the used market here over the next couple of years. This is a chart that's showing our forecast of lease maturities by the different fuel types. And these are mostly the off-lease vehicles that are going to be traded in. And one of the things to note is that because we had such limited sales back in 2022 and 2023, the market was relatively muted in the post-COVID days, and we were leasing at a very small rate. The total amount of off-lease vehicles was relatively small, so we have a bit of a limited supply of these gently used type vehicles, but it's going to be growing over the next couple of years, reflecting the recovery of the market, 3-4 years ago. But the composition of the vehicles that are going to be coming back is going to be many more electrics there in green, and plug-in hybrids in orange, and that's from the big beautiful, or excuse me, the Inflation Reduction Act and all of the move towards leasing. Well, that's going to start coming back home here in the next couple of years. We're going to have 500,000 electric vehicles by 2027 coming back to the used vehicle market off lease. And a huge portion of these are going to be Tesla Model 3s and Model Ys. So it'll be interesting to see how well Tesla holds up with their new product sales when they've got a whole bunch of gently used couple-year-old vehicles of the same nameplate out there in the marketplace competing with their new products. I'm not sure they're quite ready for that level of competition that they're going to be facing from themselves. The last thing I just wanted to talk about, because this is one of the things I think we're going to get more attention here in 2026, is autonomous vehicles. And there's really been a battle that's been going on across the country between Google and Tesla. They're fighting to take over this lead, and it's really a battle of technologies, with Google pushing LiDAR technology, which is essentially kind of light-sensored radar that beams out from the vehicle and tells the vehicle where everything is, and then cameras, which Tesla relies on. They have cameras for everything that feed into a central computer, and is then analyzed to decide where it's safe to drive and where it's not safe to drive. And they have different approaches. LiDAR technology focuses on geofencing, where the vehicle is only allowed to travel in certain areas, versus what Tesla is trying to promote, these batteries, where there are no boundaries, where it's able to go everywhere. They've been both have been testing their products aggressively in different markets around the country. Many big cities are seeing these vehicles roll out, and they're becoming more and more accepted out there. I know many folks have said in the past, I would never get in one of these things. But I think it's starting to wear people down, and I think they're starting to get more and more accustomed to these things. I think the real threat for the automotive industry, though, comes from Tesla's technology, because if they can crack the camera-based autonomous driving, it would really, I think, not only be revolutionary, but they could expand it and scale it to a large volumes really quickly. They have the ability themselves to produce 500,000 of these robo-taxis. And in fact, they're going to start production in 2026 of robo-taxi. And these are vehicles that don't have a steering wheel, don't have a brake pedal. It's essentially a robot vehicle that's going to be driving around. And I think that it's going to be a technology that people are going to have to get used to. But if they can crack the code and make this thing safe, I think it could really take off across the country quite quickly. There's still the problem of sunrise and sunsets, and everything that I've read about this is that's one area where the Tesla cameras just have a very challenging time, is when you're driving into the sunrise, you're driving into the sunset, and the sunlight blinds the camera, and the vehicle doesn't know where to go or what it's seen, and that's when accidents seem to be happening. And so that's one I think that has to be cracked. But the other interesting thing about these robo taxis is that the full self-driving capability will be built into every Tesla vehicle that's sold to consumers. So those vehicles that do have a gas pedal and a pedal and the the brake pedal and all that, those vehicles with the full self-driving, I can own one of these vehicles, come home, park it in my driveway, and then say, you know what, I'd like you to go out and Uber for the evening and make me some money. And this vehicle could go out and just start driving around self-driving and be revenue generating, and then come back into your driveway at 6 o'clock in the morning in time for you to go off to work. Now, certainly there's all kinds of issues around that of, I would never let a stranger in my car and making it dirty and all of that. But there are many people out there that would be willing to do that. And I think, again, if this technology can be proven successful, it opens the way for all kinds of folks to have their own little mini fleets. And we could see the idea of people buying a whole bunch of these vehicles and having their own 8, 10, 12 vehicle fleet that they would then manage. And they certainly would need servicing of these fleets. So that's something to keep in mind. The long-term aspect of this is, I think, this could really be beneficial to many consumers, because the cost per mile should be substantially less than vehicle ownership. Because there's really no downtime for this vehicle. It's only being used when people need it. It won't ever be sitting around, and that means the cost per mile is going to be going down. But I do see that there's quite a bit of threat from this, because it does mean that a lot of folks might not need to own that second car, or certainly folks in urban environments may find that there's enough of these robo taxis and autonomous vehicles driving around. It can provide all of my transportation needs. I no longer need to own my own vehicle. And I think the other longer term threat is the insurance on these robo vehicles, these autonomous vehicles, has to eventually be driven towards zero, because the technology itself won't make mistakes. It's as the technology advances and gets better, any errors are going to be reprogrammed away, and it's going to say, hey, well, based on the wind speed that the wind was out at that time and how fast the other driver was going, this little fender bender wasn't my fault, and I've got all the data to prove it. It was the human driver's fault. And I think at some point it means that the cost of insuring vehicles is going to fall solely on human drivers, as autonomous costs go lower and lower, their insurance cost exposure. So that could be the other mechanism that drives humans out of ownership. So, this is not a 2026 problem. This is more of a 2036 problem. But I do think it's something that everyone should be aware of, because that's one of the things I think we're going to hear a lot more about here in 2026. So just to summarize for the year, we're significant uncertainty, but we do think that there is slower growth ahead. But as I said, we do have a wealthier buyer today, and so that is going to provide some protection for vehicle sales out there. And inflation pressures, as I mentioned, is rising for both new and used vehicles. Less demand will take some of the heat off of prices. But if we do see strong demand, and that could be strong here in the first quarter, as I said, thanks to those tax refunds, we could see inflation ignite quite a bit. And again, the change in the battery electric and plug-in policy is going to hurt sales over the near term. I don't think there's any doubt about that. But I think over the longer term, the move towards more ICE vehicles, I think, is going to be more helpful for the industry in terms of reaching higher volumes and being able to make products that are profitable for the manufacturers and are of interest to consumers. So I think on the whole, it's probably a net plus for the industry. And lastly, as I said, spring surge is possible. Hope springs eternal. Let's hope that we do start the year off on a good foot as a result of these tax returns. I think that could be a nice way to start the year, although we don't expect it to last for much more than beyond the first quarter. So those are my comments. If you guys want any additional insights, Cox Automotive is always putting all kinds of articles and stories on our website. I urge you to go to Cox Automotive Insights for some of the various things that we post and stay up to date with what's the latest and greatest going on in the industry. And with that, I hope everybody has a very happy holiday, and I hope to talk to you again here in the new year.
Charlie, many thanks for joining us today and throughout the year. We value your presentations and look forward to having you back next spring to recap Q1 and the spring surge. We'll see how it all shakes out. For those on the line, you'll all be receiving a copy of this presentation and recording by early next week. To learn more about AIADA, visit aiada.org. Thanks for joining us. Happy holidays and have a great day, everyone.